So I guess you guys liked my Crash and Doom video yesterday. It got like about 10 times the views I normally get. So thank you so much for watching those. And thanks you. We got a record amount of subscribers yesterday. So in today's video, we're going to talk about kind of news like this. First quarter economic growth was actually 2% up from 1.3%. The first thing you would think if you're watching this is like, that's fantastic news. The economy's growing. But in this world today that we're sitting in, that's bad news. Why? Because the Fed sees this as, oh man, it's overheating more. The economy is overheating more. So we have to do something. We have to continue to raise rates. That's what I think is going to happen now. So let's get over all this context so we can put this into explanations for you. Why now I might not be thinking there's a recession on the horizon, and how the consumer might be buying their way out or buying our way out of a recession. So let's get over to the headlines that we see. First quarter GDP, like I said, is up, and it was revised, and it was revised up, and it's shocking the markets right now. So let's get over the headlines that we see right now. Resilient housing market benefits our home improvement construction piece. Mortgage demand grows, driven by sales of new homes. So new homes, we talked about that all the time. Existing homes aren't there. Existing homes, when we talk about existing home, it's basically a house that somebody lives in now and puts it up for sale. Okay, that's all you need to know. Why there's no inventory is because nobody's putting their house on the market. I had a caption here and I didn't want to put it in here because it just adds to the length of my video. New home sales are up 20% year over year. Existing home sales are down 20% year over year. So that basically means we're at net neutral. Okay, that's what's causing or helping support housing prices. Because if we had a ton of people throwing their house on the market, plus we have about 1.2 million people in litigation, or I won't say litigation, they're in kind of mortgage workouts. So think of this. You have existing houses not coming into the market because people have rates of under 4%. A lot of those people are going to rent those homes and then buy new homes. Okay, so that's one piece of it. Then we have 1.2 million people in mortgage workouts. So that's another 1.2 million houses not coming to the market. Existing homes, like I said, people aren't putting their house on the market. And even I've talked to friends of mine, they're like, my rate's so low, I'm just gonna rent out my house and buy another house with the minimum down payment. So that's what people are doing right now. So let's really dive into what the Fed's looking at and why growth in our economy in today's world is bad. The reason being is, let's go through here. And I bring up these charts a lot, and I haven't done it in a while. So what we're looking at right now is consumer disposable income. This is how much money people had in the bank during the last 50 years. Okay, this is put out by the Federal Reserve. Okay, you can see it right here. And it says real disposable personal income. So this is how much money people have in their bank accounts over history. So let's go through this and just look at some things. If you see through here, look at this analogy that we're having. You start back way in the 1960s, and everybody was saving money, try to, put some money in the bank, have a better life for them and their family. Then all of a sudden right here, what happened? It spiked. It spiked to levels we've never seen basically in history. So if you dig into that, what happened during this time frame? Well, you look at the history and it's like, okay, well, it's 2020, beginning of 2020. What happened there? COVID. Everybody lost their jobs. Well, didn't lose their jobs. They were forced to work out of their houses and so forth. But then the stimulus checks started. And it's not only that. Let me put this into perspective real quick. During this time frame, what happened? The government came out and said, if you have a mortgage that's funded by Fannie Mae or Freddie Mac, that's irrelative. Probably 80 or 90% of the mortgages out there today, you don't have to make a mortgage payment. All you have to do is call your mortgage servicer and say you have COVID-related financial issues, and you don't have to make a mortgage payment for almost 2 years. Okay, so a lot of people elected to do that, even people that really didn't have to. So now you don't have a mortgage payment. Well, let's fast forward as well in that. Then you have rents. Well, there was a rent, basically a halt to rents. People didn't have to pay rents for a while. That was about 18 months as well. So if you didn't have a house payment or rent payment, okay, what else might you have? Well, you might have a student loan. Well, student loans were on deferral, and they just are starting back up now from 2020. So for 3 years, people didn't have student loan debt. So if you add that up, you didn't have a mortgage payment, or you didn't have a rent payment, and you didn't have a student loan payment, okay? But let's assume, like most people, they kept their job. You might have got a little bit of a pay cut or something like that. So what happened? Well, this is what happens. people then put their money in savings. And it's proven right here. I'm not making this up. How else would you have a spike, the biggest spike in history from people's disposable income, how much money they have in the bank? Okay, so this is what caused basically this, and supply chain issues caused or is causing inflation. So let's get over to the other piece of the puzzle, the M2 money supply. And again, this is reported by the government. The M2 money supply is basically how much money people have in checking, savings, in short-term investments. Okay, you're going to see right here. See where it's starting to, it capped out about a year ago or May of last year. And then it's starting to deplete from there. So people are starting to take out money. They're starting to use up that excess money. Here's the debt people have that right now, though. So if you look back here pre-pandemic, you go through here, and I just did the numbers. Back in Q1 of 2020, household debt was 10.1 trillion. Okay, you fast forward over to here, first quarter of 2023, 12.38. A 22% increase in debt from the consumer, okay? So they had the money, they're getting the money, they're starting to deplete it, and now they're starting to charge everything that they're buying on credit. Is that gonna blow up in our face? Well, here's the national debt. This is the debt ticker. This is pretty cool. If you go down through here, you're gonna see US debt, and you come across here and you're gonna say total personal debt, and then you have credit card debt. Look at this ticker going. It's not going down. It's going up. Okay, so what's funding all this? Well, people are starting to run out of money, as we're seeing right here. Well, not run out of money, but they're starting to really suck in or suck into that savings account that they had. Now they're putting all that money on credit cards. What's going to happen if the Federal Reserve keeps continuing to raise rates and raise rates and raise rates? That's the scary part about today's market, is a lot of people are funding their spending habits with credit cards now. So it's keeping the economy robustly going because, as we can see on the GDP is revised up. So that means people are buying products, okay? They're getting manufactured. People are buying and buying and buying. That's the concern with the Fed. So then when we look over this, why is it kind of bad news for housing? Well, if you go over to this is telling us what the Federal Reserve is going to do at the next meeting. Well, if we rewind about 3 months, the expectations they were going to increase rates one more time and be done with it, because we thought the consumer was starting to slow down, the employment numbers were starting to come down and everything else. But now with all this new data coming out, what's the predictions? Well, here's what we're at. We're at the Chicago Mercantile Exchange, the futures market, and this futures that we're looking at right here, the tool we're looking at, is what is the likelihood that the Fed will change the federal target rate at the upcoming FOMC meeting? FOMC meeting is the Federal Reserve meeting. The next meeting out right now is in July. So let me get my head out of the way. If we looked at this about 3, 4, 5 weeks ago, even 2 months ago, the column that you're seeing over here right now, the 5.25 all the way to 5.75, those weren't even there. Okay, we capped out right here. We thought everything was going to end or halt at 5 to 5.25. So this is what where the federal funds rate is right here. Federal funds rate currently is 5 to 5.25. Now there's a 90% chance that the Federal Reserve is going to raise rates at the upcoming meeting on July 26th. If you also see this, they're supposed to hold on to those rates until the early part of 2024, and that's when they're expected to pivot. But guys, here, let me give you just some tidbits. Back in 2020, I think it was 2020, September of 2020, and parts of 2021, the Federal Reserve came out and said, we have no plans at all of raising rates until at least minimally 2023. Okay, well, let's rewind. What did they do in 2022? They raised rates at every meeting they had, 10 times. Okay, then in 2023, they continued that rally. And then just at the last meeting, they paused. My concern was, guys, let this cool off. But I'm almost positive, and I'm going to come out on a limb on this one. The rental or the housing expense ratio, I just read a report yesterday. It says housing payments, or however it's calculated in the CPI, that's the consumer inflation gauge that the Federal Reserve watches. Those numbers since June of 2022 are now down 8.6%. Okay, so that figure right there is a third of the inflation number that we get. So once the Federal Reserve gets updated data on housing and see that housing affordability or payments have dropped 8.6%, it's going to be a big change to the CPI and the inflation numbers. We also see gas. Gas is coming down considerably. Oil prices used to be at $120 a barrel. Now they're about $60 a barrel. We have lumber. Lumber is at about an 80% discount of where we were about a year and a half ago. So commodities and a lot of other things are really retracting right now. So with all this data out there, let's check on what's going on with the economic data out here. So here's to confirm what's going on. So Federal Chairman Powell speaking again in front of Congress, I think it is today. And every time he talks, the hair on the back of my neck stands up because I don't know how the markets are going to react. But then we have GDP. GDP, the initial number came out at 2.6. Expectations were 1.4. It came in at 2. Okay, it's telling us the economy's kicking, but we're going to continue to watch this. But here's one concerning piece for the Fed, but not me. Initial jobless claims. Here's the number that came out previously was 265,000 people filed for the first time unemployment claims. That was supposed to stay steady at 266. It actually went down. Less people lost their jobs than was expected. That's freaking out the Fed because the Fed keeps thinking we need more and more people to lose their jobs so people stop making the money and stop spending. Well, I don't think that's really going to be the fix there because we see that people continue to spend. So what's going to be the catalyst to this? So with all this data, well, let me just give you my take. Here's what my thoughts are. So we have an economy that's clicking pretty good, other than the housing market that's kind of complete bust right now with the Federal Reserve trying to really crash it. The consumer is healthy right now. We just showed they have money in the bank. Okay, people have jobs, and this is saying less people are losing their jobs. We need to get inflation down, and all the actions that the Federal Reserve has done to this point is really helping. They just need to give it a little more time, and during that little more time, the economy should just stabilize. I am now on the point where I don't think we're going to have a recession because I think the consumer, the people are going to go back to work. That we're staying at home because they had ample money. They're going to go back to work and they're going to continue to pay their payments and they're going to try to struggle along with things that are going on right now. So I think just over time, when the inflation numbers start to decrease even more and we get closer to the 2% trigger, we might have just avoid a recession. And because the consumer has so much money, they're starting to taper back and everything's starting to kind of gel a little bit more. But we need the Fed actually just to kind of halt for a little bit more and let more and more data come in. So without further ado, where are mortgage rates today? So if you want to check out where mortgage rates are in general, just go to Mortgage News Daily, click the Mortgage Rates tab, and here's the top 6 products people use when they're getting a mortgage. So here's what I get a lot of times is, Dan, you quoted me a rate the other day and it's higher than this. So let me give you an example of where these rates come from. Mortgage News Daily, what they do is they survey mortgage lenders all over the country and they say this: if you had a consumer or a buyer that fit this profile, they were buying their first house, it was their primary home in a single family home, has to be those criteria, 740 credit score with 20% down. 20%. You don't need 20%. You usually just need 3%, unless you're a veteran or in a USDA area where you need 0% down. This would most likely kind of be where your rate would be. There might be some fees or there may be points involved in that, but that's what your rate would be. So if my rate that we quoted you is a little bit higher than this, well, you probably you weren't a first-time home buyer for the single-family home that's your primary residency with a 740 credit score and 20% down. So how do you figure out how much you qualify for? How much can you afford? How much, just what questions do you have that you need answered if you're looking to buy your first house? Well, please visit us at therateupdate.com, and there's multiple ways to reach out to us. The best way I would suggest is giving us a phone call. Just call in at 844-775-5626. Or if you're like, Dan, I need to just apply because my lease is coming up and I just need your help finding a house, finding a mortgage, finding, all the supporting documents and everything else. Just teach me how to get through this. Well, just click the apply now button. You'll be on your way. But if you're out there and you're like, Dan, I can't get a hold of you guys because I work a ton. By the time I get home, you guys are closed and I'm really not comfortable applying for a loan just yet. What can I do at that point? Well, easy. There's a consultation button down below. All you need to do is click that, schedule an appointment with me or one of my Mortgage Advisor so we can answer any questions that you have. So thanks so much for watching, guys. I greatly appreciate you guys watching yesterday's video. It was a crash and doom thumbnail that I used, but I tried to put in context of what's going on, and we had a record number of hits yesterday afternoon. So thanks to you guys out there, and I hope you continue to watch. So God bless. Have a fantastic day. I'll see you tomorrow. Bye-bye.